Okay, we're going to get started. Thank you for joining us today. We have a panel of distinguished individuals from the industry, so what we thought we would do in terms of getting this kicked off is give you a brief background on everyone that is up here, and then we have figured out a sequence for how to begin our initial remarks. We are going to do everything we can to try to have a conversation and not just a sequence of 5 presentations and then Q&A. So we'll try to maintain somewhat of a dialogue here initially, and then we'll open it up for Q&A afterwards. But that being said, if you have a question, just step up to a mic. We'll take it, because we want to make this as interactive as possible, and hopefully that'll make it a bit more interesting for everyone. I'll lead off. My name is Dan Lubin. I'm going to be the moderator of the panel. I'm the founding partner of Radius Ventures, which is a health and life sciences focused venture fund in New York. And we spend a lot of time and energy in the whole area of mobile and wireless healthcare and software. So it's not our only area of focus, but it's a main area of focus. We have a number of companies that we've invested in that are addressing the market that mHIMSS and HIMSS in general target. I'm also involved with HIMSS. I've been a sponsor of, Radius has been a sponsor of the HIMSS Venture Fair and the mHIMSS Venture Fair, and I'm also chairman of the mHIMSS Advisory Council. So, we like this area a lot, and we've tried to be involved from an organizational standpoint in trying to promote, wireless and mobile healthcare. So that's my background, and I guess what we're going to do, I'll go in order of the sequence. So Neil, if you could just a few minutes on yourself and Ziegler.
Great. My name is Neil Borg. I head up the corporate finance activities and am an advisor to our principal investing in the healthcare services and IT markets for BC Ziegler and Company. Spent about 17 years in and amongst the healthcare services world. I started with a firm called Hambrecht & Quist, ultimately rolled into JP Morgan Chase, but always with a focus on working with the most innovative stories in the marketplace. We have continued that motif of trying to work with best of breed companies, and a lot having to do with wireless or remote monitoring solutions, with the goal of connecting them with some of the larger players in healthcare, from large managed care companies, hospitals, providers, so on and so forth. When we get into the discussions, I'll be in charge of kind of setting off the tone of just the broader corporate finance, M&A market, investment market, and giving you a sense of what we see as really a transformative time in healthcare.
My name is Max Kahn, and I'm an investment principal at the Merck Global Health Innovation Fund. We are a $250 million venture fund that's funded by Merck, the pharmaceutical company. But what's interesting about our fund is that we do not invest at all in the core businesses of Merck. Instead, we are looking to make investments in adjacent spaces in healthcare, particularly around healthcare information technology and healthcare services and solutions, as part of an effort from Merck to diversify beyond the pill. We're certainly not the only strategy in that vein, but we are one of the more prominent strategies for Merck to do so. And ultimately, in our investments, we're looking to find companies that provide acquisition optionality for Merck. And being that we're a venture fund, we're certainly not expecting to purchase every company that we make an investment in, but by doing venture stage investing, it allows us to see a broad range of opportunities before we make a larger investment and ultimately acquire a company as well. The fund has been in place for 2 years, and we've actually invested committed most of the capital to the first fund and have a second fund pre-approved to get started next year as well for another $250 million. As far as my personal background, I've been at Merck for 1 year now. Previous to that, I've been in healthcare for approximately 20 years and have spent a lot of that time in the mobile and healthcare information technology spaces, mostly with pharmaceutical companies as well as in consulting. but looking for how the healthcare landscape is evolving and how those companies need to evolve with the landscape as it's changing.
My name's James Nichols. I'm a Managing Director at Fitzroy Health, a firm I founded 4 years ago. We're an advisory firm and also make some investments in high-growth healthcare companies. I'm pretty much on the other side of the transaction to these guys. I'm helping high-growth companies, some startups right through to mid-sized companies, raise capital, and also to expand into new markets. I have a couple of the companies that I'm working with here. We have a pretty strong focus in the mHealth space, but are working right throughout the healthcare services area. My personal background is having worked in healthcare research and consulting for a number of years. I then founded a company in the Middle East doing healthcare services, so I know what it's like to be entrepreneurial and feel the pain that's associated with that. And now I'm focused on helping others raise capital and grow their companies through expansion. Oops.
Hello. Yeah. Good afternoon. I'm Florence Hasseltine. I recently became an emeritus scientist from NIH, and I'm here representing the social entrepreneur side of the healthcare sort of app development business. 20 years ago or more, I founded a Society for Women's Health Research, which basically it's a national nonprofit organization, and we're mainly the thought leaders in differences between males and females, always an interesting and exciting topic. And we're dedicated to improving women's health through research. More recently, because we are a broad-based organization and not a disease-specific, we have partnered with Verizon in their shared success, which you may have heard about this morning, and we are funding startup development of innovative things in women's health care, mainly mobile app development. One of the hard things, as you probably know, is the ability to get some funds in that area, and I'll be discussing that.
Hi, I'm Mitch Goldman. I'm a partner in the law firm of Duane Morris. I'm in the healthcare practice group. I've been a speechwriter on the Hill in healthcare. I've been a hospital administrator. I've been a consultant, and then since I couldn't figure out what I wanted to do, I became a lawyer. And I spend most of my time now working with healthcare entrepreneurs and providers, dealing with the regulatory and payment issues that most of the clients we have are concerned about, especially the entrepreneurs in our practice group. Most of them are coming to me because they're trying to figure out how to get paid one way or the other, whether through its insurance or through hospitals or other providers. By way of background, I've been at Duane Morris now for about 15 years. The firm is about 800 lawyers located in about 25 cities in the U.S. and a bunch of cities abroad. But fundamentally, we've stayed focused to a core mission, which is to work to develop a healthcare practice that really helps to integrate both our provider side of our practice with our business side of our practice. And we've managed to help a lot of our clients very recently navigate this very complex mobile health space. And essentially, I'm going to be talking about the impact of healthcare reform on creating new opportunities for healthcare entrepreneurs.
Okay, so just to recap here, the purpose of our panel is to really get at current industry trends, the challenges and insights of trying to be a startup or an entrepreneurial-oriented company in this area. We're going to start with, really the capital markets and the strategies and themes around that, move to direct investment, move to, the strategies around the individual company, the governmental and social elements of that, and then why is this all happening now? So if this goes the way it's supposed to go, that's sort of how this all knits together. Now, before we get started, we thought it would make sense to have some sense of who is in the audience, just so we know who we're talking to. So I think the way to do that is to just ask a couple questions, and if you don't mind, please raise your hand, And if I miss a general area, maybe you could just raise your hand and yell it out. But how many folks in the audience are actually entrepreneurs or involved working for early stage companies and are here to learn about that? Okay. How many of you? That's a good group. That helps. Yeah, that does help. Whose idea was this? Was it yours? Mitch, thank you. That was Mitch's idea. It was a good idea. Okay, so now the next, who is working with maybe, let's just say, more of a provider or physician, clinician, provider orientation? Okay. How about on the payer side? And maybe just general company or technology company? Government? Mm-hmm. Investor? Investment? Okay. Yeah, I remember. We've seen you before. Okay, good. I think we got it. So I believe our comments will actually be relevant then to the audience. So with that as a backdrop, Neil, all the pressure's on you now. You have to get this started off. You have to make this interesting. Try to be a little funny so people laugh, and let's get the show on the road.
Great, thanks, Dan, and I appreciate everyone joining us this afternoon. We thought we'd just start with a general backdrop. I mean, clearly there's been a lot of activity across the healthcare M&A, mergers and acquisitions, and investment market, both private equity and venture capital. There's obviously a lot of entrepreneurs in the room where capital is of key note, and so I think our conversations today will be very relevant. We've taken a tact at Ziegler to really target companies that are trying to change the healthcare face of healthcare delivery or the system in general. And with that, some of that comes a lot of teeth biting, a lot of banging down doors, a lot of trying to tell stories and position companies with obviously a very difficult market environment from a seller standpoint. And so with that, we've seen some great stories come of light, and I think it's really a testament to the focus of both the U.S. government as well as everyone in this room to try to transform healthcare. The activity from an investment angle and from the sales of companies has never been as high. These types of transactions, although have always been consistently high volume in healthcare, are really changed from either from lab companies being sold or physician practices being sold. You're now seeing for the first time healthcare IT companies being bought by managed care organizations. You're seeing a lot of broader-based IT companies getting into healthcare. You're seeing investments being made by some of the larger players, both in the United States economy. So it's really a fun time to play. We started this year thinking that there'd be a great chance to participate with some of these larger organizations in getting them involved in healthcare, especially with some of the younger companies. There's a few parties up here that I've worked with in the past. We have an investment in a company called HealthSense, which is a remote monitoring business utilizing wireless technologies both in senior living facilities and the home setting. And we not only had Radius join us as a partner a few years back, but West Wireless, who are obviously well known at this conference, as well as Merck and an organization called Fallon, all came to invest over the last couple of years in this story. And I think it's quite fascinating of seeing so many different types of healthcare participants wanting to play in the mHealth space. Similarly, we were involved in a transaction earlier this year with a company called Certified Data Systems that was bought by Humana. Humana, United, and Aetna all purchased companies in what we would call the healthcare information exchange world. Once again, it's something that we never really have seen in the past, albeit maybe a little bit. Managed care really trying to become a big integrated delivery network for all intents and purposes, let alone all the physician practices they continue to look at purchasing. So I think it's a wonderful time in healthcare. Back in the late 90s, I think we saw a host of organizations get into healthcare, albeit dip their toe, and we all know what happened with the internet market stumbling. But I think this is different this time. We are seeing, so once again, the Cerners of the world, Merck's, J&J is still making investments, the hospital organizations, Ascension, and others, really make concerted efforts to invest in not just their core businesses, but ancillary opportunities across services and IT, especially in the demographic of seniors and the aging world, and people being focused on aging in place. So I think it's here to stay this time. I think there's a good period of run, both from where we look at it from an activity, from a mergers and acquisition standpoint, as well as for you all to see capital investment and continue to build businesses. And so one of the things I was thinking, maybe just a quick a transition over to Max, with HealthSense in general coming in this year, it'd probably be great to even talk about how Merck found that investment of interest, as it's not so core to your core strategy of drugs.
Sure. Well, why don't I, maybe first I'll just talk a little bit about the strategy behind the fund, and that can lead into specifically what we found attractive about HealthSense. So Merck obviously is a long-standing pharmaceutical company, and in addition to the pipeline issues that the industry has been going through to a certain degree over the last 10 years, the landscape in terms of how products are sold, how they're reimbursed, has changed quite a bit as well, right? Now, it no longer became good enough to just show in a double-blind study that your product worked, at least as good or somewhat similar to previous products. You had to show superiority, health economic benefits, and a whole lot of other information beyond just the traditional outcomes data that we would have done in the past. And as part of that, there's become a lot of recognition that healthcare, the delivery of healthcare is becoming much more integrated, and that the way that people are going to be treated in the future, and it's starting now, but it's certainly not 100% there now, is in a much more integrated fashion, right? Where you have more coordination around care, that you have a better ability to keep someone on whatever therapy program they're supposed to be on, and additional information around how that person is doing throughout throughout that treatment period, or on their care plan, or forever for someone with a chronic condition that can then be adjusted in more effectively and in real time, as well as there can be interventions that occur if a situation is worsening in a more effective manner. So the question becomes, well, how do you build that integrated solution? And the answer is you're not going to build it all overnight. So instead, the tack that we've taken is that Merck should be a part of this, right? That a therapeutic is one part of this integrated solution, but it's not the only part, and that the most effective way for delivering care in the future is going to be part of a more integrated, broader-based solution. The second piece would then be, well, where do you start, right? We have the therapeutic. What other areas should we start in? And we've really taken a tack that data is kind of the currency that enables, and that technology-enabled care is the way that this will eventually grow. And so with technology-enabled care and using data as the currency for that, you really start with, well, what data do you have right now? And there's some data that we're currently getting, biometric data, et cetera, data that comes off of EMRs, but then there's new data that you can potentially create, new molecular diagnostics or new remote monitoring technologies. Once you have that data, and that's where HealthSense really fits in, right? HealthSense is an ability to monitor seniors in their home, to understand. It's in a lot of ways, it takes relatively simple technology, because it's motion sensors, it's bed sensors, it's toilet flushing sensors, it's whether or not someone's opened the refrigerator or not. The magic is not the monitors themselves. The magic is in the way that the monitors are linked together and use algorithms to make that data medically useful. In kind of somewhat the similar way that a lot of us as parents will look at our children. In particular, I have young children, so I look at my children, I can tell that they seem off today, right? I'll bet they're sick, and right, 9 times out of 10, either someone teased them at school or they're sick. HealthSense allows is really the same concept, but using technology instead of a person or a parent. It provides an ability to say this activity is off from the norm, and what does being off from the norm mean in terms of what might be wrong with that patient. So that's a new set of data that allows you to do an intervention much sooner, especially in the elderly community where that group is not particularly good at saying, you know what, I'm not feeling well, maybe I need to go talk to someone about that fact. And to be able to intervene much more quickly before it becomes much more serious. Whether it be a fall, where you can use the technology to identify that someone has fallen, and you can intervene in that much more quickly before it becomes a much bigger issue. Or whether someone has a urinary tract infection because they're flushing the toilet a large number of times, and you can, again, start the course of treatment much earlier than you would have otherwise. So once you gather new data, the next layer is the ability to integrate data. So the healthcare system, right, data is incredibly siloed. We all know the issues around this. So we've also invested in a company called Liaison that has really good tool sets for integrating disparate sets of data and putting it into one place so you can have a much better picture of whatever person, population, whatever it might be that you're trying to look at. Once you have the right data set, that data needs to be analyzed, right? So then there are a company called Humedica is a good example of one that we've also invested in that is a data analytics company that takes that data and turns it into something useful that can be acted upon. The next stage is then creating decision support tools and or tech platforms that allow the patients, providers, caregivers to act on that data. Now, when we talk about building a system, kind of from somewhat the building blocks up, we haven't necessarily made a lot of investments in that higher level yet because we're still kind of making sure that the foundation is there in creating the right data, having the right data put together, and then making that data useful. Hopefully the next step is to make it useful right at the point of care when the when the clinician is actually seeing the data right away. Now you could argue that HealthSense in some ways it has alerts, it does provide that kind of ability to intervene, which it clearly does, but it, the next step even for a company like HealthSense, plug that into the physician's office, provide that data, when that patient potentially is going to see their doctor so the doctor has a much better view of the patient and what's been going on with their condition. Another good example would be a company called Preventus that's a heart rate monitoring company, and someone that has CHF or other types of heart problems, if you can provide an output of the and some analytics around the data that's been collecting over time when that person goes to see the doctor, that's a lot more data than the doctor has right now in terms of just taking the reading right then, comparing it to the last time they were in there and asking how the patient's been doing in between. So when we think about companies, right, we think about companies that can act in any one of those individual areas as a standalone business by itself, right? We're not looking to kind of create where you have to link these things up for them to work. Each company has to have a value proposition in whatever stage of that, of the development of an integrated solution could be. But then we also look for how can we link these companies together to increase the value of the individual companies, but also increase the value of the solution that they may be collectively providing as well.
Okay. Max, that's great. And I want to ask a question, and then hopefully that's a very nice transition to James. So the concepts that have kind of come up between you and Neil have been around healthcare delivery innovation, care coordination, chronic disease management, integrated solutions, data, technology-enabled care, decision support. I mean, these are probably a lot of the folks that are here today are thinking about how their particular company might impact that. What drives value? If I am an entrepreneur and I'm trying to create, let's just pick a number, $50 million of value in 12 to 18 months, which is particularly ambitious, but why shouldn't we be? How do I do that? With Neil, with you as an investment banker and advising companies and knowing what the market's looking for right now, and Max, as someone who invests in the companies and is writing checks for companies that you think are on the right trajectory, what are the drivers of massive or large-scale appreciation of the enterprise?
I think the bar, and Dan, this is a great question, the bar is definitely getting higher, not only from our world as far as trying to market a company both for investment or sale, but even watching our clients try to sell their products, services, or technologies to some of the larger players. Proof points are key. I mean, there used to be a point where technology was neat and nice and everyone should try it and see if they can get some use by either their members if it's managed care, or residents if it's senior living, or so on and so forth. But now people really want to understand proof points before they start any type of large-scale deployment. And the concept of even get a demonstration project with some of these organizations has become just virtually impossible without continued persistence, without continued effort, and ultimately typically the use of capital. And so I think it's proof points are key. Proof points can be done in a lot of different ways. Obviously, using the product or service or technology is critical, but then really tying it back to how it's going to be used in kind of everyday life, by that institutional organization or your customer is key. And if you find the proof point, whether it's some form of ROI, whether it's going to dealing with cost containment, better coordination of care, whether it's driving increased customers, that's where it's all going to these days. I mean, that is the absolutely fundamentally great thing. Just creating great technologies. It used to be enough. And now it's the proof points are key in really all aspects of what we do.
Yeah, and I think it comes down to showing hard dollar savings for whoever your customer is, or hard revenue increases, and it just depends a little bit on what the solution is and what your customer is. So for a payer, it's often going to be, can you reduce medical loss, right? And that's a very hard bar to Neil's point. That's a very hard bar to show. But if you can show that, right, then you'll have a strong value proposition to payers. For hospital providers, it could be either that you're improving some administrative function and reducing costs, or it could be that you're getting someone or having someone reducing the average stay in the hospital by a certain amount of time. Or, especially more recently, if you can reduce readmission rates, right, that becomes a value proposition for the hospital, that they'd be willing to spend money for the benefit that they're receiving in terms of, reducing their costs by getting someone out the door faster, or preventing them from coming back in and dealing with the penalties that have been instituted. I think in the doctor-provider space, it tends to be a bit more revenue generation, I think, still. I think, especially smaller, as you get to be bigger practices, they start to think a little bit more like a hospital would in terms of both their back office and their front office. But in smaller provider settings, right, it's mostly about revenue. They often don't understand as well. It's a harder sale to convince them that you're going to save costs in their back office. Not that it's impossible, but I think it's harder. But you can convince a doctor that you can increase their revenue. And I think a few companies have been successful in doing that.
Great, thank you. Okay, so James, Fitzroy helps companies raise money. You provide advice on strategy, product development. What do you think about what you've heard from Neil and Max, and what can, how can you maybe build the conversation and take us in another direction?
Well, what I didn't hear was how you make $50 million in 12 months, but hopefully we'll get to that by the end.
I've got my pen. I'm waiting for that because I'm going to take notes on that one.
I think it's important to point out that people who are writing the checks, what you're saying is absolutely consistent with what I'm hearing. I've been involved in a lot of capital raise pitches before. Some have been successful, many have been unsuccessful, and I think what you're sharing is absolutely consistent with what I'm hearing. I'd throw them into two different buckets where there's a lot of traction in the market right now. The care access and delivery is key, and then adherence and compliance, even more so, is extremely attractive to a whole range of potential investors. I don't think there's any news in sharing that, but one thing I was listening, what I was thinking when I heard Max speak was about how creative you need to be when you are capital raising. Because here you have Merck, a major pharmaceutical company, investing in all sorts of different companies, and I didn't hear you talk about any investments in scientific developments, and I think that's a good thing for this conference. I think that there is a lot of need for the big pharmaceutical companies to look at what their existing portfolio is doing, how they can extend those franchises, and we can wrap it up in all sorts of terms, however way you want to do it. But there is an effort in these big corporations to try and improve compliance and adherence. There's an improvement to your bottom line, there's an improvement to the patient's lives, and I think playing along that theme in a capital raise is quite helpful. And so you have big strategics like Merck and other organizations. There are insurers that are willing to take bets on all sorts of different companies that may not be logical fits. So what I would encourage people to do is when they're looking at who their potential sources of capital are, to be as creative as possible and include potential funders who you may not have been thinking would be a good fit. There are 4 different things that I hear frequently in capital raise meetings, in pitches, that go above and beyond the usual. They're looking for solid management, a good basic concept, something that addresses a need. And I describe them in these sort of 4 ways. Firstly, there's a tendency to identify the need and the problem in the market, and that only goes halfway. And you really need to explain exactly what you're going to do. And that speaks to the need to point to hard proof points, any hard data that you can come up with. So going beyond merely explaining what the problem is and how you're going to fix it in loose terms is critical. Otherwise, you're just left underscoring a pretty obvious need in the market. The next is demonstrating traction, which is very difficult when you haven't got any capital in the first place, or if you are very short on capital as a early stage company. But there has to be a way to demonstrate that there is what you're doing is actually having an impact. And if there's a way that you can generate data points and proof points that the investors are looking for, that's, I'd say, just critical. There are some exceptions of pure startups that have been funded, but it's difficult, and I just don't think it's realistic. So I think finding some way to demonstrate proof is very important. In healthcare, it's always who's paying. Everybody knows that, but being very, very clear on who is paying is necessary. And I think Mitch is going to talk about the government's perspective on this, or a perspective from the government. And I think being very clear and very realistic about who's willing to pay for it is that the end consumer, is a private payer, is that the government is pretty important. It is surprising sometimes, and I think we've all heard stories of how far some companies have gone in the past without ever really showing who's going to pay for it. And that's frustrated a lot of investors in the past. I think they're particularly sensitive to that. And then lastly is differentiation. And on that particular point, I'd cite the mobile app space. I think that there is just a huge number of mobile apps out there addressing healthcare needs. Often in very helpful, useful ways that if there was nobody else out in the market, there would be a huge success. But there are others in the market. The barriers to entry are very low, and the competition is just multiplying at a terrifying rate. There's a very hot space, and so the competition is very hard to beat. And I think Florence is going to talk about the need for differentiation as well. She's focused on some app space as well. But one of the companies that I work with and sort of representing in a board capacity here is Our Mobile Health. It's a UK-based company that is actually looking to curate healthcare apps and trying to identify for large corporations what mobile apps in the healthcare space would best address the needs that they have. And I think that's probably an example of what we're going to be seeing more of. There has to be some way to get your arms around this huge number of apps and a lot of potential and latent value. And I haven't seen a real solution to that. And it'll be interesting to see how that plays out. In any case, you're going to have to, as a mobile app developer, stand out from the crowd. And if there are people who are then going to help you do that, then that's a plus. Or you have to have an extremely compelling business case to get any mind share of these big corporates, like Merck and others.
So I think that's a beginning of a handoff to you, Florence. I think we spoke about how do we actually spur app development. It's a big part of probably the opportunity to drive the wireless health industry. maybe you could share with us, some of the things that you're trying to do, and perhaps also, pick up some of the other themes that the other three gentlemen have started our conversation off on.
Thank you. I'm very interested in the use of the apps and the early development. And one of the things is that all the stuff that's being developed is going to be used by two major groups, not counting the insurance and paying section, and that's the doctors and the patients. And one of the things that fascinates me is how a new idea and a new test gets into the medical arena. For this meeting, we'll call it space. For example, I don't know if many of you know where early laparoscopic and ultrasound technology took off. So I'm not going to play a guessing game here. It was in obstetrics and gynecology. Now, you should know I am an obstetrician gynecologist, probably not common in this particular space of mobile technology, but we're used to innovative technologies. And one of the things you heard today was that it takes 17 years for an idea to get into medicine, but it doesn't take that long for technology to. And what I'm particularly interested in is this interface between the physician and getting information to and from the patient and giving information and how the patient responds. It's an area where many of you will think of ideas and hopefully make profitable advances and do quite well. I, however, come from a more academic background and am more interested in the social entrepreneurship area, which is a new terminology, meaning we give money and don't expect any results. It's the way it is. I'm interested in taking young people and getting them to think of an idea and help them develop an app. Whether that app is going to be successful or not is not necessarily high on my priority list. What is high on my priority list and critical is that a dialogue start between all these young people. The way progress is made in medicine, and I'm talking about the medical, I'm not talking about the commercial area, is a group of people form, there are no rules, no regulations, no exams, and fairly soon, within 10 to 15 years, there's rule regulations and board exams. Now, what we need in this area is we have a lot of people coming out of medical school that are quite familiar with apps and technology, and they want to do things. There are a couple people in this room who have ideas. You and I might look at those ideas and say, that's not going to be profitable. Somebody else is doing that. But in fact, we don't know that. And I think those of you who've been in the venture world know that many times you have hundreds of people putting things in, and many of you won't hire somebody to run a company unless they've failed several times. So failure is not necessary, it depends how you measure it. To me, there is no failure when somebody learns how to build an app. And as has been pointed out, it's very low barrier to entry, a very high barrier to getting and spreading what you do. So we're interested particularly in the area, of course, of women's health. I mean, that's our focus, but it's not the only area. So we're working with young people. I'm actually doing a lot of what, I guess it's called farming. I'm looking for people who are physicians who have an app or public health people who want to build something and trying to help them with startup funds. These are almost impossible to get these days. Not very much money, but also help in meeting them up with technology. Now, my hope and dream, of course, is that this will develop into a large medical network that goes beyond my capacity to know everybody in the area, and probably already has. But I think that this is a group of people that many of you in this room I would encourage to become friendly with, because they're the people who are day to day in the field, seeing the patients, faced with terrible problems. One of the people in the room, and I'll let him introduce himself if he wishes, is worried about hospital readmissions. This wasn't something that was there when I was a practicing physician. If a patient had to come back, they had to come back. But now they come back, and that means your hospital isn't going to get paid, and that causes a lot of distress. So I think that we're seeing new pressures on them, and that what is going to happen is many of these people are going to start thinking of ways to solve the problem using technologies with which they are familiar. So there is a whole world out there for social entrepreneurship in this area, and it doesn't necessarily mean that it's going to be profitable right away. You're not going to be able to measure it in the ways that many of you need to measure it. I mean, if you have investors, you have to be able to measure. But what will happen is it will provide platforms for many of you then to, quite bluntly, sell your applications. There have been huge numbers out in the exhibit hall. It's fantastic. There are all these products that can help people measure their glucose level, measure their activity, measure their inactivity, et cetera. So where I come from is not, as I said, the money side of it in the sense of, is it profitable to build? I come from the area where it's profitable to learn. Thank you.
Florence, that's great. Thank you. And a good segue to Mitch. So, Mitch, we've been talking, what came out both with James and Florence were a couple concepts. One was paying, and that seemed like a pretty important idea to put on the table. The other is physicians and patients, and the concept of, just hospital readmission, that whole, just one of the many pressures that are, in the market today that are changing the way the system has to operate. Maybe you could use your background and experience to share with the audience what's driving it now, why now? I mean, because we're 10 years behind, like everyone else in the world, the industry is, when it comes to really leveraging the power of these platforms. And yet there does seem to be so much energy and focus on it now. Why?
Yeah, well, I think there's an obvious answer, and then there's a not so obvious answer. Obvious answer is driven by basically the demographics. Okay, I do this very frequently when I was teaching our Democratic side of the Senate how to explain health care and why they should never tell anybody that health care costs are going to go down. You should never tell them that. And I explained it very simply. I said, this is the perfectly insured population. Lots of healthy people at the bottom, very few sick people at the top. This is you get this by having lots of young people at the bottom and very few old people at the top. We have this. There's no way that health care costs can go down. Now, can we reduce the rate of increase? Yes. But the pressure to go up is so high. And at the same time, ironically, we passed a bill with 32 million new covered persons. Regardless of the policy, and I was totally supportive of the expansion of coverage, we didn't add one new physician. Not one. Okay? We can talk all about other types of providers, but if you don't think we're in a really dire situation right now, with the demand going up and the capacity to service that demand staying flat or decreasing, because what people forget is that primary care physicians don't want to treat 4,000 people a year. Okay? They have an opportunity to go into what's known as concierge medicine, where they can treat 600 people a year. And you'll pay $2,000 or $2,500 a year for the privilege of having greater access to those people. So we're in a very strange situation, and it's part of how our process works. I don't want to go through the issues, but I always start out these conversations by asking a question, and I'd like all of you to be honest. How many of you read the entire health care reform bill cover to cover, all 4 versions, including the one that Ted Kennedy never got to see? How many? Thank you. Okay. Well, then the 2 of you, if you've read all the versions, did something that most of the United States Senate didn't do. Okay, and I can tell you that because I was sitting there. And what I think you need to understand about policymakers and how this impacts you is that we're not making policy in a way that takes into account all of the moving parts. Healthcare is just too complicated for this kind of system. So what does that mean? I mean, where do we end up? And what happens with clients of mine all the time is they're trying to find out where the pressure points are, where can we add value, Okay? And there are simple ways to kind of look at this. One of them is the Healthcare Reform Act did one very significant thing. It provided demonstration funding in a number of different areas to create a new form of delivery system. So for those of you who know what an HMO is, the HMO takes a premium, guarantees the subscriber that they'll provide care for a certain scope of benefits, and each individual doctor is paid separately, and nobody cares about the patient. They care about their individual services, and the HMO cares about not paying out more than it takes in. That's not working now. Silos are not working, and when you look at the aging population, what's the biggest problem we have? Chronic care. Okay? So we have more and more people becoming aging and then having all this chronic care, and we have no way of trying to deliver it, and we're delivering it in silos, way too expensive. So an accountable care organization basically is structured to take care of the health of populations, and they're at risk. The insurance company now is going to contract with this new entity, push the risk down to the doctors, and compensate them on a pay-for-performance basis where the doctors will get something less than full fees. And if the system as a whole, not them individually, but if the system as a whole is successful, they'll get a portion of that bonus. Now, what that does for an entire system is make care coordination the #1 priority. We've got to find a way to talk to each other. We've got to find a way to manage a patient. When you look at chronic care, the new model now is called the medical home. And if you take a look at the medical home, it's a new way of delivering primary care where the primary care provider and the group of specialists, whatever the chronic disease is, are in some way capitated. They have, again, a fixed amount per patient for a year, hypothetically, and whatever's left over at the end, there's a formula to distribute it. They have the same issues. So the patient who has diabetes, who bounces from the primary care doctor to specialist to specialist to specialist, now they've got to really figure out how to keep the overall cost of that individual down. So what the Healthcare Reform Act is doing by changing the delivery models is also demanding some new healthcare IT. And it's interesting to see what you're dealing with when you go into a hospital. I was up at the hospital for special surgery, and this has nothing to do, the comments I'm going to make now have nothing to do with the quality of care. It may ultimately, I hope not. I had my mother there yesterday, okay? And my mother is very, very tech savvy. She was on television talking about how she has an iPad, an iPhone, and a laptop. She can't use most of them very well, but that's okay. And she goes in, and I said to my mother, when we go in, she's going to be admitted, take a look at how many pieces of paper they give you. And, of course, she walks in and how many? 14 different pieces of paper. And my mother takes out her iPad, and she turns around, and she says, do you have one of these? And the guy looks at her and goes, well, we should, but, and this was the key, our system's 20 years old. Our legacy system's 20 years old, and it's going to take us forever to change it. I was in shock, that it was quite honest. I know it's been maintained, and he was quick to say it's very fast. But in terms of their ability to get to the issues that you're talking about, when you come down to the issue of being able to have technology-enabled, in any way enabled technology, and to be able to have data at the point of care, we got a long way to go. And this is a good example of where we're getting started. But this system really needs to be overhauled. And it can't be overhauled when everybody's in silos. So the delivery system now is going to, the changes in that system, accountable care, I believe, is going to enable us to have that conversation and to provide for many, many more buyers. Let me just take one more digression and then I'll close. The point about primary care can't be lost here. There's a real opportunity for entrepreneurs to figure out how to make physicians much more productive. And whether that has to be through use of social media, I'm not a tech expert. I've seen a lot of different things. A partner of mine and I have been talking about a client we have that does, it's basically telepsychiatry, okay? A lot of the hospitals don't have psychiatrists, and when a psychiatric patient shows up in an emergency room, they have a problem because they can't control that patient, and it makes the emergency room dysfunctional. And so he's out with a technology that would enable a psychiatrist in one place to talk to social worker and a patient in another place, okay? But there are regulatory problems with it, but the fundamentals are it's all focused on making doctors and hospitals more productive on the delivery end. There's going to be more and more demand for it. We can't solve the primary care problem, but we are solving it in the marketplace doing certain things. Any of you get flu shots from a pharmacy? Yeah. You're going to do more of that. Okay? The Walgreens of the world, the Rite Aids, the CVSs, they're all going to be doing that. Why are they doing it? Because there's a real market for it. Urgent care, anybody been in urgent care lately? Okay? You're going to start to see people using all those models because that's another driver the system need to be focused on. Just to close, I would just make one pitch to those of you who are out there doing your apps. What we see on a regular basis are some incredibly creative people who show up having really thought out a very good healthcare problem. The only thing is they never really focused on the regulatory aspects that govern that app. You need to be clear, and it will make your sales so much more compelling if you can do two things. One, have identified all the possible pitfalls. If you look and smell and feel like a device, you better be thinking about the FDA. If you're concerned about taking patient information that's going to be shared, you've got to be thinking about privacy. And if you're crossing state lines doing something with the physicians, you got to worry about the practice of medicine in those various states. We see great ideas that just haven't thought through those major problems. And with that, I'll just say, it's nice talking to you.
Thanks, Mitch. That's great. So just to maybe take a couple of, I think, the most important elements of that, the last a couple speakers, we've discussed this issue of rising healthcare costs, the capacity efficiency dimension of that, the fact that there's going to be growing demand, and I think, which is an area that we spend a lot of time on, the fact that the system is restructuring and risk is being reallocated. And when risk gets reallocated and money gets moved around in different ways, that creates a demand for innovation and to do things differently. So I am going to assume and I hope that those in the audience that are on the entrepreneurial side are probably touching on some of the the themes that have been mentioned by the panel. So before we start asking each other questions, maybe this is a good time to give you all a chance to participate, help us make this a better event, and perhaps you could ask some questions and get us started, and we'll see if we can get the audience to take over. Okay. Yes. Go ahead.
Yes. My name's Rob Campbell of Volt Incorporated. We're an early stage company. We're fully financed, and I'm interested in how to build value as we enter the next stage of our company life. One of the things no one discussed is the relationship of recurring revenue versus more one-time revenue streams. What I'm finding new to healthcare is that hospitals, who we sell to, don't want to deal with recurring revenue. Yet the marketplace tends to value recurring revenue as much as 3 to 4 times as much as they value one-time revenue. So I'd like to hear the comments on, in an industry that devalues recurring revenue in the selling process, how do you build the value for an eventual liquidity event?
So before we, don't sit down yet, because before we answer that question, and obviously, there is the flip side of recurring revenue or subscription revenue is a significant capital outlay. So I would argue that there's a lot of buyers, customers in the marketplace that would prefer a subscription model, even which is effectively recurring revenue, to shelling out the total value up front. So what is it that you're doing? Just to give us a little, before we answer your question, tell us what you're trying to do with hospitals.
So we provide clinical communication systems to acute care hospitals. It's a client-server-based system that operates inside the hospital, principally for the point-of-care workers, nurses, hospitalists, pharmacists, phlebotomists inside the hospital. And hospitals, in our experience, and we're 4 years in now, like to go find a bundle of money and spend it and are very uninterested in subscription models or CapEx models or recurring revenue models.
What's your ROI?
ROI is improved productivity and reduction of patient events, sentinel events, due to falls.
Do you have a validated hard dollar ROI that you've been able to demonstrate with your clients?
No.
Okay. Let's stop there, because I think that's where, maybe we can pick up on that a little bit, because I think that's
what I'm getting at is I'm not having any problem with selling.
Right.
But what I'm having a problem with is the pricing models.
Right. Okay. Anybody want to help out here?
Yeah, I can jump in. I mean, so we look at companies that sell to providers, and they're at hospital providers in particular, and we see the same thing, right? Hospitals have not necessarily converted to that, and I think, listen, in the short term, you have to go with what your customer wants, I don't think that hospitals are necessarily going to stay there forever, but I mean, listen, if you're selling and the hospital wants to pay up front, and I don't think there's anything you can do about that, despite the what the trade-off might be, right, from a value standpoint. Now, on the other hand, though, you can you need to figure out, you could figure out from a modeling standpoint, as you're talking to investors, the fact that you're economically equivalent anyway. That's one way to do it. I think another way to do it, which I think on an enterprise level might be hard for your company, but just for others in a similar stage, is we've also seen companies that can sometimes sell at a department level instead of at the enterprise level. Yeah. And if you can sell at the department level, departments often just have budgets. They don't necessarily have capital. They don't necessarily have capital allocations, and we've seen them more willing to go towards a subscription model because of the fact that they're dealing with budget and they actually have to do it the other way. But when you are talking about at the enterprise level, particularly for in the IT departments, they still do like to, a lot of them still do like to pay in that way. I think that will change over time, and I would make sure that you have the ability to change, on a dime, because when it does change, or when you come across someone that has changed, you do want to try to get, into the situation where as much of your revenue is recurring as possible.
Go ahead. You want to add to that? Because I'm going to do a follow-up question based off of that question.
We sold a business not too long ago for about 15 times revenue, and half of the revenue was license fee, and the other half was recurring. The board or the investors about 3 years ago realized it was just as challenging. The major product they sold was fairly expensive, $500,000 to $1 million. For capital outlay, and realized it was going to be too hard to convince hospitals to go to a recurring or subscription model for that type of capital dollars. So instead of trying to retrain the hospitals, they accepted that for that component of their offering, used that cash flow to reinvest in other functionality, ended up buying some other components that were kind of smaller dollar items, and ended up leveraging their installed base to sell more product. And so the mix of revenue ended up being about 50-50. But because there was still so much visibility into the recurring side, and people got the kind of Trojan horse strategy, we were able to achieve far superior kind of revenue type multiples, simply because of the integrated product platform.
So do you think, Neil, that was the company did that, or was it just exquisite investment banking advice that resulted in that incredible outcome?
A lot of both.
Yeah. Okay. Just wanted to make sure.
Understood.
But one of the ththings that I'd like to just put a question to the panel and then maybe go back to the audience. But it's the whole issue of the reference account. The strategic customer and the reference account, and how important that is from your standpoint. What should an ideal strategic customer reference account look like to help validate and provide the proof points that young companies need to start to build traction, both in the capital markets as well as with, let's say the second movers and from the customer standpoint. James, you want to take a crack at that?
Yeah, I'll take a crack at it. It's difficult because reference accounts can go away, and they can be horribly harmful, and I hate to start with the negative, but it is true, and I've seen it happen before. So it is incredibly important to get a customer who represents what the rest of the marketplace looks like, willing to say, this product worked, this service works, and here is how it has improved our efficiency, here's improved our bottom line. So years of, of relationships, even if you haven't been demonstrating the proof over that whole period of time, as long as the relationship is there, a lot of this is a very personal, sort of nuanced validation that you get. It's not always, here's 10 years of data that we can point to, but it's, here's 1 year of data, and we've been working with them for 3 years, and we're very pleased with what we've seen. That can work. But I would also say to put too much emphasis on one single reference client can be dangerous.
That's really good advice. Okay. I think we got a question back there. And again, hopefully this is going the direction you want it to go, but if it's not, then you're in charge of getting us to go somewhere else. Go ahead.
Hi. So my name is Mustafa Patney, and I'm with a health and wellness startup called Higgy. And really, our mission in life is to raise consumer awareness about their health status and then engage them in behaviors and ultimately, obviously, monetize those behaviors and engagements with our platform. So I guess the question I have for the panel is, I hear a lot of discussion about going direct to providers, going direct to insurers as kind of the revenue source, but I don't hear a lot of discussion about direct to consumer. And I'd love to hear you guys' thoughts about that and what you think overall the odds of success are for a startup going direct to consumer.
So before we answer that, it's a great question. But before we answer it, is your current business model focused on actually going, and how is that?
Yeah, we're direct to consumer, so we have a little bit of a unique twist on how we acquire and engage consumers. We're literally in the midst of deploying a health station network across the country. So those old blood pressure machines you have in the back of the store, we're replacing them with what we call Higgy stations. And they do a little bit more than just the blood pressure. They take weight, they take pulse, they take BMI. And they actually have the opportunity to do a few more things in the future as we sort of grow the functionality of the station. But ultimately what we're trying to do with that and the web and mobile is to raise awareness within the consumer of what their status is in terms of their health and well-being. So, alerting them to, they're hypertensive or they're obese or any other condition that we can screen for in the future on this station, and then actually engaging them in healthy behaviors so they can take simple changes in their lifestyle, simple steps to improve that. And then from that, our plan ultimately is to monetize those folks by bringing in sponsors, bringing in providers, bringing in insurers to help sort of walk them through a path to well-being, and along the way, hopefully we get paid.
Great. Okay, so I'm going to slightly different angle on the question, but I think we'll get at this hopefully through the answers. To the panel, the most exciting, valuable, direct-to-consumer play that you've seen and why? Neil?
Yeah, I'll start. And this is an old story, but I think one that will resonate quite well. In 19...
You may want to...
sorry.
We don't want to miss a thing, Neil.
Yeah, very good. 1995, 1996, there was a company started called Sapien Health Network. Sapien Health Network was one of the first consumer-focused health portals tied to specific chronic disease states. That story was funded by Sprout and a few other investors at the time. And it was just the beginning of the internet, as far as consumer use, let alone use of healthcare. In 1998, 1999, that business was acquired by what was then Endeavor Technology, soon to be called WebMD. And ultimately it was the front-facing consumer portal of WebMD, since been morphed many times over. But it all started with the idea of trying to work with the pharmaceutical companies for sponsorship and investment and cash flow, or really try to aggregate eyeballs, going the consumer, basically the consumer strategy. I think that's hard these days. I mean, I really think it's a big capital game, unless it's some other. It's obviously Facebook, Twitter, all those things we see and use. But in the healthcare, I feel like the world's moving to who can aggregate lives. And how do you get access to the people that has those lives and can control the use? And that's why I think you've heard a lot of talk today about managed care, about some of the larger providers that can direct use and direct people or direct their residents or patients. Just because I think the world's changed a little bit from the days of trying to allow for more consumer-focused strategies. Not saying it's impossible. I just think it's good to have partners go into that.
Well, I mean, I think one of the challenges we have is obviously the inefficient, the amount of capital that we end up funding in our companies for sales and marketing is such a significant part of the equity dollars that go into your business, and so you're looking for efficiency there, and it's nice to start your process with aggregators. And I think the problem with the direct-to-consumer is, who's aggregating those lives for you so you can get at the consumer efficiently. One of my advisors, just to kind of give you an interesting play, my answer to my question, but one of our advisors is a guy named Mehmet Oz, and Mehmet is, is a TV doctor, and but before that he was actually a phenomenal heart surgeon. I think he still is a heart surgeon. But Mehmet started a company called ShareCare, and if you have a minute, just go to sharecare.com. It's kind of cool. But that's an example where there are some groups out there that are actually doing the aggregation of the consumer for you. So if you can somehow coax those aggregators of the consumer to actually do some of the hard work for you, obviously that deal needs to be cut on terms that work for you. That is, one way to maybe get some thrust behind what is otherwise, I think, a really hard way to build a business. But others on the panel?
Yeah, just a thought. I've had no success with direct-to-consumer because people would never really come to me for any of those kinds of issues. However, having said that, there are a couple of things that I would encourage you to focus on. Employers, okay? I had a very long-standing relationship with a group that does employer wellness for the Fortune 50 companies. And if you saw what Toyota and some of the others spent, they have a real interest in what you're doing. And again, you're talking about aggregators, you're talking about corporate types really would look at depending on what the value proposition is and everything else. But you're talking about direct-to-consumer. In our business, the way it's currently structured, and I suspect things are going to radically change, but the way it's currently structured, employers have a real say in what's going on. And you're going to also find the same thing, just from a healthcare reform perspective, in the exchanges. For those of you who don't know, there's going to be a market set up, a virtual marketplace, electronic marketplace, to sell insurance to individuals and small groups that, for one reason or another, are not covered by their employer or not covered at all. And there may be some opportunities in that space to sell. I mean, it'd be interesting to see what's going on in Massachusetts because they have an exchange set up, and you may find that there are some real opportunities for that way to get directly to consumers.
That's great, Mitch. That's good for a lawyer.
So the only thing I'll offer up there real quick is, we're definitely pursuing that market in addition to our direct-to-consumer strategy. But one other thing I'll kind of point out, at least in the context of health stations out there in the U.S. alone, last year's statistic on that is over 70 million consumers engaged with one of those health stations. So we kind of think of that as a unique way to go after the consumer. 70 million is not a small number. No, so
thanks for the question. It was very, very good. We got one more here, but this may be our last question, depending upon how fast it is.
So Dan asked the question, how you're going to create $50 million in a year and a half. Remember, he asked you. He didn't volunteer an answer. But in any case, I wanted to ask the question about timing and the scale trajectory. Now, many of you made the point that it's about proof points. But if you think about the teachings of Jeffrey Moore in terms of crossing the chasm, he says that proof points in the early adoption stage doesn't really help us cross the chasm. So help me understand in this space what you do to sharpen your vision about when scale takes place and how to enter. Because as you reference with HealthSense, it was a motion sensor company. There was their predecessor company that raised maybe $30 million only 5 years before to have several wipeout and cram down rounds. So what do you do in your timing, in your analysis to avoid that?
By the way, we should make you answer the question too. So don't run away. But go ahead. That's a really great tough question. And I'm not answering it.
I think the healthcare space is used to, right, sometimes putting enormous values on before anything is sold, right? And if you just think about the pharmaceutical sector, biotech, medical devices, same thing. So I think the answer becomes is that the more clinically driven it is, right, so, and you're showing true clinical outcomes, then the more that you can drive value just based on your studies, assuming those studies have, you know, enough rigor that they'll be that they'll be considered valid in the market. The more that it's more of an administrative, you know, on the other side of the spectrum is going to be more an administrative, where you're going to have to build it in more of a traditional way, and you're not going to just generate value without revenue to prove it. I think a lot of the companies that, you know, may be represented here, and certainly the ones that we look at, fall somewhere in between. And so, you know, the answer is that you can't necessarily create all of that value just based on your data, but you can create some, but you will need to have some track record in terms of adoption in the marketplace as well. So, I mean, you know, basically the more that it's just a straight clinical outcome and that you've proven it with strong studies, the more that you can generate that value just based on those studies.
You know, and obviously, we want your answer, because I think that was a really great question. I'm sure you have a point of view on it. But, you know, we sold 2 companies in the last year, one for $120 million and one for $180 million without any revenue. Now, they were medical technology companies. And so we know that other parts of the industry have really accorded a lot of value to bringing companies with good clinical data, validated data, FDA approval on the verge of the market, and then the big companies that are looking for growth engines pay up. It's different here, and I think it's a lot harder because we have more of a hybrid model. But you know, because of some of your own experience, maybe you could share, you know, give us your answer to the question.
As John McLaughlin would say, the answer is no. That's an inside the Beltway joke. I think from the issue of finding scale is very hard to predict. There's an old Arab saying, he who predicts the future, even if he gets it right, lies. But the answer from the VC perspective is it's a 1 in 10 shot. I only have to hit 1 or 2 of them to make it work, and so I can make a lot of mistakes. I mean, characteristics that I might look at for scale, I come to the show the last 2 years, the attendance has catapulted. But does that mean that scale takes place? And where I make real money is to hit the scale right at the right time when it's going to launch. You know why? Because I can make a lot of mistakes in the business. But if scale is there, I'm going to be able to monetize my success. And I suspect that you can model out early characteristics of when scale takes place. When Steve Jobs introduced the Newton, he didn't have a big enough ecosystem. We now have a very large ecosystem here. But for many of these companies in remote patient monitoring, essentially a $200 million industry, if you just look at it, and in the motion sensor industry, probably less than a $20 million, $30 million business, when do you get to a point when scale takes place? And there's certain ingredients in the ecosystem and certain ingredients in the investment cycle and in the buyer mentality that probably you can model out and identify with some kind of clarity that increases your success, other than play the 1 in 10 game, just invest in enough deals that you minimize risk and upside opportunity. I don't know.
Great question, and great point to end on. Unfortunately, we're out of time, but I want to thank the panelists for their remarks and thank the audience for joining us and participating.